Hello, everybody. Welcome to Cordant's market update for the end of the fourth quarter 2022. So in this market recap, what we're going to do is we're going to cover everything that happened in the fourth quarter performance. We're going to look at where we stand in terms of market valuations going into 2023. We're going to take a look at the topic that's certainly in the news and probably on certain people's minds, which is, are we going to have a recession in 23? What do the indicators say there? And then something that we've been dealing with for a while, inflation. We're going to take a look at where we're at with inflation. So stay tuned. Let's get into it. So how did we do in 2022? As you're probably aware, markets were down. Bond markets were down in 22 for the whole year. So for the year, global markets, so this is U.S. plus international, down a little bit over 18%. Last year, the U.S. market did a little bit worse than that. Developed markets outside the U.S., Europe, Japan, et cetera, did a little bit better. So overall, not a great year. We had a bear market. We bounced back a little bit in the fourth quarter, which we're going to take a look at, but overall down a little bit more or a little bit less than 20% for the full year. One thing to always remember, though, is from a market psychology or consumer sentiment perspective, oftentimes when things seem the worst, the markets actually return the best. So this is a chart from JP Morgan. I think it's a pretty good one here that just looks at consumer sentiment versus S&P 500 returns. And as you can see, when sentiment kind of bottoms out, that's actually some of the best market returns going forward. So something to keep in mind as there's some pretty negative outlooks going into 23, something to definitely keep in mind there. So fourth quarter, how things go. Actually, fourth quarter was a good quarter. The first three quarters of the year, not so much, but the fourth quarter was a good quarter, basically up across the board. So whether that's you're looking at U.S. markets, you're looking at developed markets, emerging markets, real estate, bonds, interest rates fell off a little bit in the fourth quarter after rising substantially in the rest of the year. Interest rates dropped, and therefore bond market returns were positive in the fourth quarter. So let's dive into each of these areas of the market in a little bit more detail. Here in the United States, the U.S. equity markets make up about 60%. This has dropped as international markets have outperformed a little bit this year, but make up still about 60% of the global stock market. And for the fourth quarter, value stocks tended to perform the best, up a little bit over 12%. Small value stocks up 8%, and kind of the worst performing areas of the market are large growth and small growth. So there's a lot of these growth names that have done well over the past few years. These are, think about some of the mega cap stocks of Tesla, Facebook, even Amazon, Microsoft, some of the bigger names there really had a hard time last year, and it kind of shows up in the fourth quarter as well. That trend continues. Internationally, same story. So internationally, value, some of the best areas of the market, growth being some of the worst areas in the international market. That makes up about 30% of the global market cap. The other thing to pay attention to here is in U.S. dollars, the performance of these stocks actually did better than they did in local currencies. And what we saw in the fourth quarter was the U.S. dollar actually depreciating against some of the other currencies. That is, again, a reversal of a trend that we saw, really have seen for several years now, the U.S. dollar getting stronger and stronger, and that hurting international investing returns. We saw that reverse in the fourth quarter. In addition to kind of value outperforming growth in the international markets as well. Emerging markets, same story again. Value outperformed, growth underperformed. The U.S. currency adjustments, so the U.S. currency didn't perform as well as the emerging market currencies in general, so that helped returns in this area of the market. Emerging markets make up about 11%. Another thing that kind of changed, a lot kind of shifted in the fourth quarter. Commodities had been doing really well throughout the year. Third quarter, they actually fell off a little bit, but commodities were a strong area in the full year of 2022. Not so much in the fourth quarter. A little bit of positive returns in aggregate. A little over 2% returns for commodities in the fourth quarter. Obviously, some things being up, nickel, silver being top performers, natural gas being a laggard in the fourth quarter. But some moderation, and we'll look at this when we look at inflation later, a bit of moderation in commodity prices in the fourth quarter. Okay, let's shift gears a little bit and shift to kind of where we stand as we're going into 2023 or where we're ending the fourth quarter. So, first thing I want to look at is just market valuations. So, in the US, anyway, valuations are basically in line with their historical averages. So, again, this is a chart from JP Morgan. We looked at this last quarter, but basically, if you look at the amount you're paying per dollar of earnings in the US, it's more or less in line with the average that we've had since 1997. So you can see kind of the tech bubble on this chart in 2000. You can see kind of the run up in 2020 after or post COVID, and now back in line with historical averages. So that's in the US. Internationally, I don't have the chart here, but things are actually priced more attractively in the international markets. If the US markets are fairly priced, which is a good thing going forward, international markets are actually at a value relative to where they've been historically. So that's one thing to keep in mind going forward. The other things, just to put last year in perspective, kind of the drop that we had, the 25% drop, which was basically peak to trough, beginning of the year to the bottom last year was a 25% drop. That's a pretty normal drop for any given calendar year. What was unusual is that we had, January to December for that full calendar year, we didn't have much of a rebound from the bottom going into the end of the year. So that roughly 19% drop in the U.S. markets, makes it one of the worst calendar years, at least in this data set. So going back to 1980, kind of the third worst calendar year of any year going back to 1980. Good news is, most calendar year returns are going to be positive. So really roughly 3 out of 4 calendar years are positive. And so, that's the good news. Drop fairly normal, calendar year returns, not so normal, kind of an outlier, but typically, 3 out of 4 years are going to be positive in the equity markets. And we're going to look again about long term a little bit later in the deck. Other big question that are on people's minds right now is just, are we in a recession? Will we have a recession? Those things. So this is, again, an update of something we looked at last quarter, but the key variables that the National Bureau of Economic Research looks at when determining a recession, when dating a recession. And right now, again, 5 of the 6 key variables are either positive or at least not negative. So household employment is basically at 0. It's flat. It's not negative. The only one that would be negative would be wholesale and retail sales. But other than that, personal income, employment, consumer spending, and production are all positive going into 2023. So there's some good data out there. If you look, a lot of the headlines are negative, but if you look beneath the headlines, a lot of good data in terms of how the economy is doing right now. The other thing to keep in mind as we talk about a recession is markets tend to lead the economy. So we could be in a recession now, or it could be announced that we're in a recession, and the markets could have already dropped and are already on the rebound, even if we find out later that we are in a recession. So we did a little bit of work on this, looking at the last couple recessions. So the Great Financial Crisis, the global financial crisis, and then the COVID recession. And if you look at when recession was announced to start and end, markets are actually up over that period, up by about 40% in each of the last 2 cases. And so key takeaway here is don't time it. It's really hard to get the timing right. And even if you could pick these dates, oftentimes the markets lead the economy and the markets are going to bounce back over that period. When it comes to recessions, the other thing we want to think about is just like, how long do they last? And this is kind of like a good news, bad news situation here of like, if we are in a recession, that would be bad news. The good news is, we might be most of the way done with that, or at least halfway done with that. So here's a couple charts from JP Morgan. And basically, typical recession's about 14 months. So if we say we started that last year, we could be most of the way through that, or at least halfway through that. And then in terms of bull and bear markets, kind of typical bear market lasts about 20 months. So again, we kind of started this January of last year. So we're basically 12 months into this. So we could, again, already be well past or well through whatever bear market drop. So a little bit of good news, bad news there as well. Now, obviously, the other big thing that's been in the headlines all of last year has been inflation. And the good news here is that inflation seems to be moderating. So we got the last CPI print through the end of December here recently. And basically, it shows, inflation kind of rolling over and starting to come down. So we've got kind of what they call core inflation, excluding food and energy, coming in at 5.7%. Total CPI at 6.5%. And obviously, hard to tell what's going to happen next year. Impossible to predict accurately what's going to happen, but a lot of good signs point towards inflation moderating. And the good news there would be hopefully the Federal Reserve sees that, starts to moderate the pace of interest rate increases that are really putting a clamp on certain areas of the economy. So again, a lot of areas are good, but increasing interest rates, increasingly tight credit does slow the economy. The good thing about rising rates, though, are obviously bond yields. The amount you're making on your bonds are going up. So again, a little bit of a good news, bad news situation. The bad news is interest rates go up, your bond prices are going to go down. The good news of that situation is you're going to make more money on your bonds going forward. And so what this chart is showing, if you look at the blue diamond there, that's just basically where yields are currently, or at least as of the end of 2022. And what you can see is that kind of at the high end of the range of where they've been in the past 10 years, which says across all these different areas of the market, you should expect to make more money on your bond holdings than you have in the last 10 years because yields are higher. The other interesting thing about bonds is there's a concept known as duration. You can basically just think about it. If you own a 5-year bond, duration would be roughly 5 years. And no matter kind of what your duration is, as long as you're planning on holding that amount of time or longer, this drop that we've recently experienced in bonds, unless you're selling as the drop happened, if you own a 5-year bond, if you're going to hold it for 5 years or longer, you're basically equal or better off because of rising bond yields. So even though you're experiencing a loss in the short term, as long as you're going to maintain a position of bonds for 5 years or longer, you come out ahead by having higher rates over that full 5 years or longer period. So that's the good news in all of this. And lastly, just want to kind of wrap up with this notion of, thinking about the long term, being a rational optimist. Markets have gone through cycles like this. The economy's gone through cycles like this where we have a recession, we have a bear market, but things tend to work out in the longer term. As investors, we should be focused on the longer term, and we should be putting our bets on basically progress and making money over the longer term. So again, another chart from JP Morgan that kind of puts this into perspective, kind of the further we go out from 1 year to 5 years to 10 years, et cetera, a lot less negative and a lot more positive. And as we think about 23 and beyond, this is the perspective that we want to take. So that's it. Hopefully this gives you a good idea of everything that happened in 2022 and kind of where we're positioned going into 23. Hopefully this is useful. As always, if you have questions, go ahead and send them in. The best way to do that, you're probably getting this via email. So just reply to that email, send in any questions, and would love to address those in subsequent market updates. Okay, thanks for watching.